Right now, SoFi Technologies, trading under the ticker SOFI, is priced at $27.65, reflecting an intraday drop of 1.66%. The stock opened today's session at $28.37 and has fluctuated between a high of $28.48 and a low of $27.56. This slight pullback today is interesting, not because it signals distress, but because it's happening against a backdrop of what many perceive as an unstoppable growth story. The common belief is that SoFi is the definitive one-stop shop for digital finance, destined to replace traditional banking for millennials and Gen Z. The expectation is a smooth upward trajectory as it continues to gobble up market share. However, the reality of its stock movement is far more nuanced and reveals a complex interplay of macroeconomic pressures and internal strategic shifts that aren't always visible in the headline numbers of member growth. The truth is, while SoFi's user base is expanding at a remarkable pace, its stock is increasingly tethered to the broader sentiment around interest rates and credit quality, creating a tension that day traders on platforms like Robinhood and interactive brokers often overlook. This isn't just a simple growth narrative. It's a story about a company navigating a difficult economic landscape while trying to maintain its high valuation momentum. The market has been intensely focused on SoFi's impressive member acquisition numbers. In the first quarter of 2025, the company added a staggering 800,000 new members, bringing its total to nearly 11 million. This feeds directly into the expectation that SoFi is on a clear path to dominance. The reality, however, is that the market is beginning to look past these top-line vanity metrics and scrutinize the underlying profitability and risk associated with this growth. For instance, while loan originations grew by 30% year-over-year in the first quarter, excluding third-party loan programs, there's a growing concern among institutional investors about credit quality. We've seen a slight uptick in personal loan delinquency rates. While SoFi's management has been quick to point out that their charge-off rates remain lower than competitors and are well managed, the market is jittery. Any sign of weakening consumer credit could disproportionately impact SoFi because its lending segment is still a core driver of its revenue. This is the disconnect. The market expects a tech company's frictionless growth, but the reality is that SoFi, with its bank charter, is also a lender subject to the gritty realities of credit cycles. This is a crucial distinction that many retail investors using platforms like SoFi Invest itself might not fully appreciate. The performance of SoFi stock is not just about adding new users, it's about the quality of those users and their ability to repay their loans in a potentially slowing economy. Digging deeper into recent stock performance, the daily fluctuations are telling. The stock has seen significant volatility, trading in a wide range over the past few weeks. This isn't the behavior of a stock that has the unadulterated confidence of the entire market. Instead, it reflects a battle between bullish retail investors who are drawn to the company's brand and growth story, and more cautious institutional players who are weighing the risks. The trading volume has been consistently high, which indicates a lot of active participation, but also a lack of a clear consensus on its short-term direction. The institutional ownership data reveals that while major players like Vanguard and BlackRock have significant stakes, there's also been a lot of movement in their positions. This suggests that the big firms are constantly reevaluating their exposure, likely influenced by macroeconomic data points like inflation reports and Federal Reserve commentary. For instance, the recent signals of potential interest rate cuts have been a tailwind for the stock, as a lower interest rate environment would reduce SoFi's funding costs and potentially spur more borrowing. However, any indication that rates might stay higher for longer puts immediate pressure on the stock. This sensitivity to external economic factors is a key part of the reality that contradicts the simple to-the-moon expectation. Investors looking for investment help or using Schwab Intelligent Portfolios need to understand that investing in SoFi is not just a bet on the company's execution, but also a bet on the direction of the broader economy. To fully grasp the current situation, we need to understand SoFi's core business structure. It operates through three main segments: lending, its technology platform, known as Galileo, and financial services. The lending division, which offers personal loans, student loans, and home loans, has historically been its bread and butter. The financial services segment is the one-stop shop part of the narrative, encompassing SoFi Money, SoFi Invest, SoFi Credit Card, and other products. This is where the massive user growth is happening. The third and arguably most underappreciated segment is the technology platform, Galileo. Galileo is a payment processing and API platform that SoFi acquired, and it provides the back-end infrastructure for many other fintech companies and financial institutions. The expectation is that the financial services segment will be the primary growth driver, but the reality is that the technology platform offers a more stable, recurring revenue stream that is less sensitive to credit cycles. In recent quarters, we've seen strong growth from this segment, and it's a key part of the bull case for institutional investors. This B2B side of the business provides a level of diversification that isn't always apparent to those who only see SoFi as a consumer-facing app. Platforms like Fidelity Investments, with their extensive research capabilities, would likely highlight the importance of Galileo in their analysis of SoFi stock, as it represents a significant and often overlooked part of the company's long-term potential. Comment below and let me know if you think the market is undervaluing SoFi's Galileo segment. Looking at the company's financial health, SoFi has made significant strides towards profitability, which has been a major focus for investors. The company has reported GAAP profitability, a significant milestone for a high-growth fintech company. This achievement has been a key driver of the stock's positive performance over the past year. The expectation now is for a consistent and growing stream of profits. However, the reality is that maintaining and growing this profitability will be a challenge. The company is still investing heavily in marketing and product development to fuel its user growth. This creates a constant tension between investing for future growth and delivering short-term profits. The company's management has guided for continued revenue growth and expanding EBITDA margins, but these forecasts are contingent on a stable economic environment. Any significant downturn could force the company to pull back on its growth initiatives to preserve capital, which would likely disappoint investors who are accustomed to the aggressive growth narrative. When you look at SoFi through an individual brokerage account, it's easy to get caught up in the daily price movements, but the long-term story is about this delicate balancing act between growth and profitability. The future outlook for SoFi is where the expectation versus reality framework becomes most critical. The expectation is that SoFi will continue to take market share from traditional banks, its user base will continue to grow exponentially, and the stock will be a multi-bagger from current levels. This scenario is certainly possible. The company has a strong brand, a loyal user base, and a comprehensive product offering. The move to a national bank charter has been a significant advantage, allowing it to lower its cost of capital and hold loans on its balance sheet for longer, capturing more of the net interest margin. This is a structural advantage that many of its fintech competitors lack. However, the reality is that the path forward is fraught with risks. The competitive landscape is intensifying, with both traditional banks improving their digital offerings and other fintechs like Robinhood and SoFi's own SoFi Invest vying for the same customers. There's also the persistent macroeconomic risk. A recession would lead to higher unemployment and increased loan defaults, which would directly impact SoFi's bottom line. Regulatory scrutiny of the fintech sector is also increasing, which could lead to new compliance costs or restrictions on its business practices. In conclusion, the story of SoFi is far more complex than the simple narrative of a disruptive fintech company on a relentless path to success. The live intraday price of $27.65, with its modest daily decline, is a microcosm of this complexity. The expectation of smooth, uninterrupted growth is being constantly tested by the reality of a volatile market, macroeconomic uncertainties, and the inherent challenges of the banking and lending business. While the company's impressive member growth and recent profitability are undeniably positive developments, investors need to look beyond the headlines. The reality is that SoFi's future performance will depend on its ability to navigate the delicate balance between aggressive growth and prudent risk management. The performance of its often overlooked Galileo platform will be just as important as the growth of its consumer-facing financial services. The tension between the tech company valuation that the market wants to assign it and the bank-like risks it faces is the central dynamic that will shape the future of SoFi stock. For those using online investing platforms, from Schwab Intelligent Portfolios to Fidelity, understanding this nuanced reality, rather than just chasing the popular expectation, is the key to making an informed decision about this fascinating and polarizing company.